Hello again. This is part 2 of the video of what to do in a market crash. So I'm going to talk about the ways to avoid it or to do well. Can we avoid a crash? Can we avoid the worst days and then benefit from the best days? Or better still, avoid the worst, avoid the best, and see what we do. But first, do like and subscribe to my channel so that you'll be notified of the next video. Property and stocks are similar. They are like risk asset classes, and the best time to buy property as with stocks is when there's volatility and uncertainty. Better still, if you're not sure whether the world is going to end, right? So the latest crisis is the COVID, and there was huge uncertainty. Let's look at Singapore's track record for real estate. Ardmore Park, very prime area. The person that bought it in 2010, 12th of August, was 9.35 million, sold it in panic at 9.2 million in a COVID sale, 2020, 8th of January. But the smart person that bought it in 2020, sold it 4 years later at 29 May for 11.85 million. That's a huge profit, right? Sunny Palms in Teluk Kurau, person bought it in 2011, 2.15 million, poor sold it at 1.8 million. This is standard classic cutting loss, right, in a panic. But the person who bought it in 2020 sold it at 3.09 million. And you can see so on and so forth is the same for every property in Singapore. And I bet you it's the same whether it's in UK, Malaysia, US, Australia. If you buy during COVID, you definitely will be in a Boomtown Charlie, you call it, right? So what about stocks? It's the same. It's the same. So in uncertain times, great volatility, buying stocks, buying risky assets, things that will go up or down in value, but generally do go up, rewards you handsomely. So what if, and I can hear your brains thinking, what if an investor misses the worst days and benefits from the best? Wouldn't that be great, right? To miss the worst days, the problem is there is no signal to get out of the market. If you use oscillators, you use something like overbought, oversold indicator, RSI. If it's overbought, it can remain overbought for a long time. There's no emotional trigger to sell. And the investor will need to buy in on the worst days during some of the most significant market drawdowns where the loss aversion is at the greatest. What I meant is this. There's this thing called clustering. The worst days and the best days happen often together. So to jump out, you will have to jump in very quickly. So unless you have a time machine, right, it is almost impossible to do that. So there's actually valid reasons to miss the worst days. And in fact, missing the worst days, right, your performance is better than gaining the best days. Okay, the consequence of missing the worst days gives you better returns than the punishment that you get from missing the best days, because when it drops generally more than it rises. Okay, so the consequence of missing the worst days are your returns jump from 6.08% for the 20 years S&P 500 $10,000 investment instead of 3x. If you miss 10 worst days, it goes to 10%, 6.8x return. And if you miss the worst 60 days, oh my goodness, it's 21.66% annualized return. That will make you a star, and it's 50x return. So wouldn't you want to miss the worst days? So let's look at the facts. The problem is the worst days and the best days are like Siamese twins. They're glued together. So how do you separate Siamese twins? How can you have the best without the worst? In March 2020, the worst day, second worst day in 20 years occurred on 12th of March 2020. It was down 9.5%. And the next day was a 9.3% rebound, fourth best day in 20 years. And they clumped within the 2 weeks. And on Monday, there's 3 consecutive trading days, right? It's 11, down 12%, the worst day in 20 years. So if they are stuck like that, you have to jump out, in, out. Who would be able to do that, right? August 2015, during that drawdown, the worst day was on 24th of August, and the best day was two trading days later on the Thursday, the best day of the year. December 2018, the sixth worst day of the year. On the 24th December, there was Christmas Eve, and the best day was on the 26th, the best day of the year. So overwhelmingly, the problem is the worst days occur before the best days. It's not as if the best days occur first, and then, okay, you sell it to avoid the worst days. There's no warning at all. So there are some trading strategies like cutting loss. Does it really work? Performance of $10,000 investment between January 3rd, 2000 to 20 years later, 31st December 2019. Fully invested, don't time the market, you're up 3x, 20 years. Now, if you sell after a drop, 8%, you set a rule of 8%, then you cut loss. You're down to 28,000, only 2.8x return. If you set a rule of 7%, is 28,698.57. Now you set a rule of 5% drawdown, and then you stop loss is 25,167.69. So the tighter the stops, the more frequently it happens, but it doesn't add value at all. So stop loss doesn't add value. Unless you're able to time it so perfectly, when you stop loss, you jump in to buy the next day, which is almost impossible. Key conclusions: loss aversion can lead individuals to take control and sell equities or sell real estate after a market drawdown to avoid additional losses. This is sure one way to crystallize your loss. This behavior can result in missing some of the best days of return because those days tend to follow the worst days with very close proximity. It's just like the intention to miss the rain is very important, but the rain, we will likely, if you want to miss the rain, you're likely to miss the rainbow. So they're like Siamese twins. So staying invested to benefit from those best days can be critical to a portfolio's recovery. Let's look at buying the dip. Now, this is something that I subscribe to, whether it be funds, ETFs, or good quality companies. Buying the dips can certainly help you improve your performance. So there was a research done by S&P Global about investing in securities that fell more than 10% relative to the broader market index, that is the Russell 1000, during a single day, significantly outperforms the benchmark for the last 15 years. If the index were to be moving, no change in the Russell 1000, and there's a 10% drop in one of the component stocks, that will lead to an outperformance. So there were many large sell-offs may result from earnings disappointments and guidance changes. These events do not impact the buy on dips or buy to the dip strategy, because what it's trying to tell you is that earnings and guidance, you may think that, oh, if it dip because of an earnings guidance or dip because of disappointments, then buy on dips doesn't work. But the research strips out all this. Does it still work even with these disappointments? And yes, it does. So even if a company temporarily disappoints, temporarily tells you that the guidance is poorer, but you believe that the quality of the company is still very good, and you go in to buy it, you're going to outperform the index. So BTD strategy can be improved, as the research say, and it's very good research, by institutional ownership. The higher the IO, the better it is. B, price trend. So when the stocks are on the rising trend and suddenly there's a dip, it might be due to an external news, a scandal, poor guidance, and it dips more than 10% versus the benchmark. It works. And valuation, the cheaper the stocks, the better the return. So which ones are the most effective? Interestingly, there is actually a lot of events that happen where stocks actually fell more than 10% versus the Russell 1000 over the 15 years. You notice that a lot of them occurred during the very volatile times like 2008, global financial crisis, 2009 during the recovery, and 2002. Let's look at the track record of buy the dip strategy. This is the forward excess returns of BTD for the last 15 years. And this is the number of days after the event that happened, up to 240 trading days. The more stars, asterisk, the better, because it's significant, statistically significant. As you can notice here, when it happens and you buy on the dips, about 1 year later, calendar year later, is 28% outperformance. That's a lot. And with a hit rate of 52%. So buy the dips is statistically proven to happen. How about high institutional ownership? The first table here is all BTT events with institutional ownership, and we assume that all of it is we assume that all the stocks, almost all the stocks, have institutional ownership. N is the number of occurrence, 6,469. Then the second table is the top half of BTD with the highest IO, 3310 occurrences. And the outperformance is 37.47% with a hit rate of 56%. 1 year later. So if you buy stocks with the highest IO, you will outperform the general BTD strategy by 8.7%. So it's a further enhancement of the strategy, and it's statistically significant for 1%. And why am I talking about all this, right? One of my favorite subjects was statistics in university. I love it. That's why I study a lot of economics, and then I branch into finance. Stock price trend, what about that? Wow, that's so powerful, right? S&P Global call it the 4 weeks to 52 weeks price oscillator, which is a momentum indicator. First table is the control number, which is again outperformance 28%. But look at the top half, the highest momentum stocks that actually dropped 10% momentarily, and then you buy on dips. The outperformance is probably the most, 49.3% with a 57% hit rate. And the bottom table is telling you that the outperformance versus a normal BTD strategy is 21%. This is by far the best strategy. So you need to ensure that the stock is already rising. What about fundamentals? So AFL valuation indicator, S&P Global, has this valuation style indicator. It's a combination of valuation signals like price to book, free cash flow to price, EBITDA to enterprise value, earnings to price, dividends to price, sales to enterprise value. So the lower the better. That means the score is very high. And this is the control, the top tier table. N equals to 8687 occurrences, but the top half of the BTD, the highest AFL scores, is 36.65% outperformance. Again, you enhance the BTD strategy with a 56% hit rate. And the difference between top half BTD with the highest AFL score and general BTD strategy is 8.6% outperformance. So there you have it. The best outperformance to enhance the BTD strategy is momentum, followed by institutional ownership, and then thirdly, valuations. And for my fund, I don't really care about the correction because I did have a drop from 138 to 121. That's close to about 11 to 12%, but I did rebound very sharply. In fact, 3.2% on Friday night. So I could have not done anything. I could have just closed my eyes, go for a holiday. I know it will rebound back. And when I rebound faster than S&P 500 or even the NASDAQ on Friday. So because I have the highest quality businesses. So it doesn't worry me. My top 10 remains what I think that will outperform. And I did engage some buy the dip strategy by selling stocks that are already way overpriced. Total shareholder returns, they are below what I expected because some of them are so overvalued that forward returns will not be that good. even though they're high quality, I did take profit, free up some cash, buy those on dips. So this strategy works. So avoiding the worst days is a fallacy, is jumping in and out is a fallacy, is a dream. Ideally, people will love that, but you need a crystal ball, you need a time machine. If you do find it, let me know. I will buy from you, I'll join venture with you. But generally, the key is to buy on dips, stay invested, look for good quality companies. And there are other things like factors like companies with wide moat, quality characteristics of the company, owner-led companies also showed significant outperformance. And if you buy on dips of these companies, then you could even outperform the BTD strategy. So owner-led will mean that either the founder is still in a controlling position, a CEO or chairman, or a founder and the co-founder and a couple of first-generation employees own more than 10% of the company. And it shows that when you really found a company and you own it and you own the most shares, there is no conflict of interest. You tend to outperform and run the company as if it's your own. But there is really nothing to worry about because Warren Buffett said that as long as you're not leveraged, and he said the things that ruin a man are wine, women, and leverage. So if you don't leverage, you're fine. You're going to survive it. So none of my clients leverage. I always tell my friends, don't leverage. Just invest with what you have and you'll be fine. Make sure there are good funds, good ETF, good stocks, and close your eyes. You're going to enjoy the compounding return. If you find the videos useful, do like and subscribe to my channel so that you will be notified of the next video. See you for the next one.